Welcome back to another stock analysis, where I'll look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze Realty Income after a request from a viewer. Let's begin with looking at the revenue. Last, they generated a revenue of $2 billion. They have a market capitalization of $40 billion, and they are operating in the real estate industry. The revenue of Realty Income is to 100% generated through rental, and they own around 11,000 properties. The clients are mainly other companies. Actually, 84% of the properties are rented to companies coming from the retail sector, 15% are coming from the industry sector, and 2% from other sectors. Regarding the geographically diversification of the company, I actually have a graphic for you which I didn't make myself, but found it in the annual report of Realty Income. It shows pretty well where the company have the properties. As a matter of fact, Realty Income do not only operate in the US, but also in the UK and a little bit in Spain as well. If you want to know more about the revenue, you can check out the annual report of Realty Income, which I have linked down below. Enough about the introduction, let's find out if Realty Income is a good stock to buy at its current value. The key matrix I use to calculate the fair value and buy price for Realty Income is the dividend yield. I'll start with plotting the dividend yield for the last few years in a historical chart. I choose the dividend yield because a consistent dividend policy for me is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio and it makes it easier to rebalance my positions. To create some sort of signal line, I take the 5 years moving average of the dividend yield and plot it in the chart. The simple approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 4.37%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. In an ideal case, the curve will give a straight line. I can measure how much the curve deviates from this ideal straight line by calculating the relative standard deviation, which for Realty Income is 15.9%. To the historical yield, add a personal defined margin of safety of 25%. This margin of safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. With this value I can measure how volatile the dividend yield is. A high relative standard deviation would higher my risk to invest at a bad timing. As said earlier, the relative standard deviation for Realty Income is 15.9%. This value is inside the yellow section of a rating scale, therefore the margin of safety doesn't change. As a dividend investor, the dividend growth of course is a very important matrix for me. In 2007, $1.57 were paid, and in 2022, $2.96 as expected. It is noteworthy that Realty Income doesn't pay the dividend on a quarterly basis like other US companies, but pay the dividend each month. Realty Income has paid and increased the dividend for 27 consecutive years, which makes them a dividend aristocrat. In the last 5 years, the average dividend growth was 3.1%. A dividend growth of 3.1% is just inside the yellow section of the rating scale. Therefore, I'll subtract 0% from the margin of safety for the dividend growth. By looking at the payout ratio, I'll find out if the dividend growth is sustainable for the company. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. the free cash flow from Realty Income has increased from $0.9 billion in 2018 to $1.3 billion in 2021. The cash dividend were respectively $0.8 billion and $1.6 billion. The average payout ratio is therefore 94%. This value is in the red section of a rating scale, and I would normally add 10% to the marginal safety. But Realty Income is a Reit, and to be qualified as such, it is a requirement that they have to pay out at least 90% of the taxable income as dividend each year. For this reason, I'm actually not taking the payout ratio into account this time. Next, I'll take a look at the debt situation. The company has a debt of $15.2 billion and has $0.3 billion in cash. Then the cash gets subtracted from the debt, and this value then gets divided by the EBITDA, the debt to equity ratio is found. The EBITDA is currently at $1.9 billion. This leads to a debt to equity ratio of 807%. This value is in the red section of a rating scale. Therefore, I'll add 10% to the marginal safety. The last thing I'm looking at is the growth of the company. The revenue has increased from $1.2 billion in 2017 to $2 billion in 2021. This gives an average growth of 13.9%. In the same period of time, the EBIT increased from $0.6 billion to $1 billion, which gives an average growth of 12.8%. The margin is found by dividing the EBIT with the revenue, which in 2017 gives 15.5% and in 2021 decreased to 48.6%. Since the revenue increases at a higher rate than the EBIT, it only makes sense that the profitability of the company decreases. In this case, it decreases with almost 1% in average each year. An EBIT growth of 12.8% is in the green section of the rating scale, which gives minus 10% from the marginal safety. An average margin decreasement of 0.98% doesn't change the marginal safety. Since every matrix from analysis has now been collected, it is time to adjust the marginal safety. I'll add 10% for the debt and subtract 10% again for the EBIT growth. The marginal safety is therefore still 25%. This leads to a desired dividend yield of 5.46%. By a current dividend of $2.96, I should therefore don't pay more than $54 for the stock. By ignoring the marginal safety, the fair price of the stock is determined, which for Realty Income is $68. These values can also be shown graphically in the chart for the historical dividend yield. This is done by adding the marginal safety to the historical yield curve. This then gives a new curve which always lies 25% over the historical yield. As seen in the graph, the historical yield and the marginal safety are both over the yield curve. Therefore, I consider the stock as overvalued. Finally, I consider the stock at its fair value when the price is $68. I will buy the stock at $54 and the stock price is currently at $66. If you did like the stock analysis, please consider to give the video a like, let me know in the comments which stock you would like to see next, and subscribe to my channel for weekly content.